Let me start with something a little uncomfortable. I've sat across the table from people who wrote a 6-figure check to the IRS because someone told them a Roth conversion was the smartest move. They paid the tax, they felt like they were getting ahead, and for a few years everything seemed fine. Then we modeled their retirement plan in detail, and the conclusion was hard to hear. They probably would have been better off doing nothing. Not because Roth conversions are bad, but because they did it in the wrong situation. And once you convert, there's no undo button. So today I want to walk you through 5 situations where a Roth conversion often doesn't make sense. So you don't make that same permanent tax decision that doesn't actually improve your overall retirement plan. If you've been researching retirement planning, you've probably heard Roth conversions described almost like a universal solution. You get tax-free growth, tax-free withdrawals, pay the tax now before rates go up. And sometimes that logic is correct. But a Roth conversion is simply a trade, right? You're choosing to pay taxes today instead of later. Now, the only reason that trade makes sense is if it improves the overall structure of your retirement plan. That could mean things like reducing future RMD pressure, smoothing out income over time, maybe protecting a surviving spouse from higher tax brackets, or improving the way that money passes to your heirs. But if the conversion doesn't accomplish something meaningful like that, you may just be accelerating taxes without actually improving the outcome. So let's walk through 5 situations where I usually slow people down. The first problem is you don't have a clean way to pay the tax. This is the most common structural problem I see. Someone decides they want to do a Roth conversion, but they haven't thought carefully about how the tax bill will be paid. Let me give you a realistic example. A couple in their 60s, they've saved about $2 million in traditional retirement accounts. They've also got roughly $40,000 in cash and maybe $100,000 in a brokerage account. They've been hearing about Roth conversions and they say, we think we should convert $300,000 this year. But before we even talk about the strategy, I ask a very simple question. How are we paying the tax? Because if the $300,000 conversion lands roughly in the 24% federal tax bracket, that tax bill might be $70,000, could be $80,000 depending on state taxes. There are really only 2 ways that the tax gets paid on conversion. The first way is from assets outside of the IRA, maybe cash, maybe money from the brokerage account. In that case, the entire $300,000 goes into the Roth. Every dollar then gets the benefit of tax-free compounding. That's the cleanest structure. The second way is paying the tax from the conversion itself. So maybe you convert $300,000, but $75,000 goes to taxes. Now only $225,000 ends up in the Roth. At first glance, that might not seem like a big deal, but think about the long-term math. That missing $75,000 would have been growing tax-free for decades. Over 20 years, that difference can easily turn into well over $150,000 of lost compounding. And this is the part that most people don't realize. The power of a Roth conversion isn't the label, it's the uninterrupted compounding inside of the Roth. So when you reduce the amount that lands in the Roth, you weaken that strategy from the beginning. So before we talk about tax brackets or RMDs, the first question I always ask is, do we have a clean way to pay for the tax without disrupting the rest of the plan? If the answer is no, then we usually adjust the strategy. Maybe we convert smaller amounts. Maybe we spread the conversions over more years, or maybe we wait entirely. Because the goal isn't simply to say we did a conversion. The goal is to materially improve the overall structure of the retirement plan. The second reason it may not make sense is because the break-even timeline is much longer than people expect. So this is the second situation that has to do with time horizon. Now, this is something that gets talked about far less than it should. When you do a Roth conversion, you're paying a tax bill today in exchange for potential benefits in the future. Those benefits take time to show up. Let's walk through a simplified example of how this looks. So imagine you convert $100,000 and you're in the 24% tax bracket. That means roughly $24,000 goes to the IRS today. That $24,000 is gone. For that decision to be worthwhile, the tax-free growth inside the Roth has to eventually make up for the tax you paid. If you're 60 years old and that money stays invested for 25 or 30 years, that math can work very well. But if you're 70, 75 years old, the timeline is different, sometimes dramatically different. In many modeling scenarios, the point where the Roth strategy clearly pulls ahead can be 15 to 18 years into the future. And that raises a very real question. Will the money stay invested that long? If someone converts aggressively at 72 and ends up needing the money 5 years years later, the tax-free compounding didn't have time to do its job. Now, that doesn't mean conversions later in life are always wrong. Sometimes they're done for legacy planning. If your children are high income earners and will inherit the account, a Roth can make their lives much easier. But if there are no heirs or legacy isn't a primary goal, then conversions have to make sense inside your own lifetime. And sometimes the timeline simply isn't long enough. The third challenge I see is the conversion triggers hidden income effects. So this is where the conversion interacts with other parts of the tax system. Most people think about Roth conversions in terms of tax brackets, but income affects more than just your bracket. It can also affect things like Medicare premiums. It can affect the taxation of Social Security benefits. There can be phase outs or deductions of certain credits. Now let's look at a typical example here. A retired couple, both 67, they're both receiving Social Security and modest portfolio income. They decide to convert $80,000. Now bracket-wise it looks fine, but that extra income pushes them over a Medicare threshold. So 2 years later, their Medicare premiums increased significantly. Suddenly, the true cost of that conversion wasn't just the tax bracket, it's the bracket plus the higher healthcare premiums. Now, this doesn't mean that Roth conversions are bad. It simply means they need to be precisely sized. Sometimes the optimal strategy is converting right up to a threshold, but not over it. The fourth challenge is doing it in a high income year. Now, another common mistake happens when people convert during a year when income is already unusually high. Examples here include selling a business, selling real estate, large capital gains, exercising stock options. When those events happen, your income is already elevated. A Roth conversion on top of that stacks additional income onto the highest bracket. In many cases, the smarter move is to let the high income years pass, then use the lower income years that follow. Timing matters just as much as the conversion itself. The last challenge I see is people doing conversions without a clear objective. And this final situation is subtle, right? You're converting, but there's no specific objective. It's just Roth is better. But in retirement planning, every major decision should have a job. A Roth conversion might be designed to, again, reduce required minimum distribution pressure, smooth out income over time, protect a surviving spouse, improve the way assets pass to heirs. If the conversion doesn't accomplish one of those things, then the strategy may not be doing much at all. Sometimes the right move is simply maintaining flexibility and letting the plan evolve over time. Roth conversions can be an incredibly powerful tool, but only when they fit within the structure of a plan. So if you're within 5 to 10 years of retirement and you're considering Roth conversions, the smartest next step is to actually model the decision. If you'd like help evaluating whether a Roth conversion truly strengthens your retirement plan, you can schedule a retirement strategy call below. We'll walk you through the numbers together and determine whether converting makes sense, and if it does, how to execute it the right way. Thank you again so much for joining us, and we'll see you next time.